Statistical analysis. Now, in our last example, we made a chart in Excel, and that is all we are going to do with charting in Excel, because as I mentioned earlier, we generally tend not to use it. We tend to use the web-based technical analysis platforms, and most of Excel will be used for other purposes, for more numerical analysis that we cannot really do using charts. So now we'll begin the next part of the lecture, which will be for the rest of the lecture, and that's statistical analysis. So what we will do is focus on how to do statistical analysis of financial data in Excel. And we will be going through some fairly basic statistical tools, and we'll also be explaining the concepts as we go along so that we understand exactly what we're doing. Now, before we go on, I want to spend a little bit of time motivating why exactly statistical analysis is so important. And the reason is that in order to build a profitable trading system, we need to have a good, solid understanding of statistics. Now, we don't need to be advanced statisticians, but we do need a basic understanding of different statistical concepts. And we'll go through those concepts in this lecture, and what we'll see is that it's not difficult. As long as you go through it methodically, you'll find that it's fairly simple to understand. You don't necessarily need to understand all the math and the calculations behind it, just what it means and how it works. So what is statistics? Well, statistics is the analysis and interpretation of data. Data is a set of numbers, essentially. So in our cases, data will usually be the price. We may also have data like volume. But the main data we will work with is the price, and we will use the price to calculate all sorts of things. We can calculate different indicators, we can look at its volatility, correlations, etc., which we'll go on to discuss further in this lecture. And think about why statistics analysis is important, right? If statistical analysis is the analysis of an interpretation of data, right? What is technical analysis? Well, with technical analysis, we are actually doing exactly the same thing. With technical analysis, we are analyzing and interpreting the data. The difference for some people maybe is that with technical analysis, we can often do it on a chart, but it's still the data, right? It's still, the chart is made up of various different points over time, and the prices at those particular points in time. And when we do statistics, we're just going to learn how to analyze that data and how to make sense of it. Let's now carry on our discussion as to what the purpose of statistical analysis is. We'll just spend a little bit of time talking about this before we go into it in the next slide. Now, I want you to take the following scenario. Imagine that we have data consisting of the daily price of a stock over the last 5 years. Now, in our Excel chart, I had the Nifty index, which was from 2005 to 2011, so a little more than 5 years, but close to it. Now, if we have a stock that we have the daily price of a stock in the last 5 years, how do we make sense of it? Right? If we just look at all those numbers together, that's not going to be very, very helpful. So we can use then statistics to create summaries of what's going on. Essentially, the statistical numbers, the indicators that will come out, is a way to describe the data and summarize it. So for example, we may want to look at the average price change in a day, or a week, or a month, or a year. That might tell us something important, right? It might tell us how much money has the stock made over time, and potentially how much can it make going forward. Now, we may also be interested in questions like, how volatile is the stock? Is this the kind of stock that tends to move up and down a lot? Or does it tend to be more stable and fairly low risk? And these are both very important characteristics. We need to be aware of not only how much can we make from a stock, but how risky is it? And how do we measure this risk? And this is where statistics will come in. Statistics analysis will help us to answer these types of questions and to make sense of a large set of data. And in particular, it'll be important for looking at the past behavior of a stock. So for example, looking at the returns, price changes of a stock, and the volatility of a stock. And additionally, also when we evaluate a trading strategy. So let's say we come up with a trading strategy and we want to simulate it, and we'll talk about this later on. I promise you that, what that means and how to do it. But let's say we come up with a hypothetical trading strategy and it creates a hypothetical set of gains and losses. And again, we may be interested in analyzing that, right? We want to know how much can we expect to make on average per day. How volatile is our strategy? Do we make and lose a lot of money, or is it quite stable? So again, statistics will come into play to help us answer all of these questions. Returns. Now the first important concept that we'll talk about is known as returns. And this is a fairly simple and straightforward concept, which I'm sure most of you know. But it is, probably one of the most important statistics you can calculate from any price series. So what is a return? A return on a stock represents the percentage change in its price over a particular time period. Now in general, that time period will be our intended holding period. So we can look at the return of a stock over a day, over a week, over a month, over a year. To calculate the return, we simply take P1, which is the current price, subtract P0, which is the previous price. So the distance between the two prices will depend on our holding period. So if we're trying to calculate the daily return, we'll take today's price minus yesterday's price. If we're trying to calculate the monthly return, we'll take the price this month minus the price last month. So we take the new price, then subtract the old price, and then divide it by the old price. And this will give us the percentage return. Now, why are returns important? Well, in general, whenever we're thinking about investing, we always want to think about stock returns rather than stock prices. So whether a stock is trading at 100 or 5,000 is not really relevant. What actually matters is how much it moves on a percentage level, right? So whether a stock goes up by 1%, 2%, that's what's important. Because it's actually the percentage changes of the returns that determine how much money we'll make or lose for any given investment. It's not to do with the actual price level. So that's why whenever we think about stocks, we're always going to be thinking in terms of returns. And we'll evaluate any trading strategy and we'll analyze a stock by looking at its potential returns. We will not be looking at its absolute price changes, because that doesn't mean a lot, right? A stock that costs 5,000 rupees will may move 100, 200 rupees per day, whereas a stock that costs 100 rupees may only move 3 or 4 rupees a day. And that doesn't mean that the 100 rupee stock is less worthwhile. It's just that because it's a smaller number, the overall movement is smaller, but the percentage change may be very similar. And that's why we look at returns. Here we are back in Excel, and what we are going to do now is show you how to calculate the returns. So we talked about what return was in the slide, and now we will use this data set that we have here and calculate it. So as we mentioned before, the data set here is the Nifty index from starting beginning of January 2005 going all the way until the end of 2011. Now before I carry on, I would encourage you to go ahead and do this yourself. And you can go to Yahoo Finance, download the data, put it in Excel, and just simply follow along. I mean, you might want to do it after the lecture is over, or you might want to do it while it's going on. That's up to you. But I would recommend you follow along. It will help help you get the most out of this course, and get you comfortable using Excel to analyze this kind of data. Alright, so let's go on now and calculate the returns. So I will put it in this column. So the returns will be equal to the current day's price minus the previous day's price, okay, divided by the previous day's price. Now I can make this into a percentage so it's easier to see. So here we're looking at the daily return, so the return from one day to the next. On the 30th of December 2011, the Nifty index had a return of minus 0.47%. Now if I want to extend this all the way down, I just have to double click the bottom right hand corner, and it magically goes to every single row. I'll just have to delete it from the very first one because there's no return. So for example, this one here didn't seem to work because obviously in order to calculate the return on this day, we need the previous day's price, which we don't have. So we'll just get rid of that one, and the returns will start from the second trading day. Okay, and now as you can see, we have a set of returns, and it was fairly easy to calculate. Mean. Now this will be one of the first statistical indicators that we will look at. The mean is essentially the average of a data set. And I'm sure most of you have come across this before. And the purpose of the mean is to measure the central tendency of the data. So if we have a large set of data, we want to know what is the average. This tells us what we expect to occur on average. What is the central point kind of thing. Now how do we calculate the mean? Well, what we do is that we sum all of the data points and then divide by the total number of data points. So in this case, if we look at the formula, we have the mean is equal to sigma xi over n. What does this mean? Sigma means the sum, and x subscript I have set that to mean each data point. So each x represents one data point, and each I represents that particular data point. So x1 represents the first data point, x2 the second data point, and so on. So sum of xi means we sum all of the data points. And then we have dividing by n, and n in this case is said to equal the total number of data points. A fairly simple formula. Now why would we be interested in the mean? Well, if we are evaluating a trading strategy, probably the most important statistic that we would want to know is the average return. And that's defined as the mean. Right? So we want to know on average per day how much money can we expect to make or lose. And the mean will tell us that. Now there are other measures of central tendency, that is measuring the center of a distribution, and these include the median and the mode. And I'll just explain what they are. The median essentially represents the 50th percentile of the distribution. So what that means is that it represents the middle data point. Right? So if I have 100 data points, the median would be data point number 50. Or 51, depending on which way you're counting. But the point is that it would be in the middle of the data set, and that would be the median, whatever that value was. So that's not necessarily going to be equal to the mean, right? Mean is the average of all the values. And the mode is essentially the most frequent number that comes up. The mode is, so if you have a data set, you look at which number comes up most often, and that is the mode. So we can use median and mode as well. In general, we tend to use the mean. This is the most, probably the best one to use. There are certain instances where using the mean will not be as good as the others. Whenever we come across that, I'll be sure to let you know. But for now, we'll just go with the mean as calculating the central tendency of the data set. Back in Excel, what we will do now is do an example of the mean. So what we'll do is we'll calculate the mean of this data set. Now what we're interested in is the mean return. So we have all these returns here, as you can see, right? We have the return, for example, this day, this day, and it varies. Sometimes it goes down. This day it was up. Some days it goes up a lot, like this day. Some days it goes down a lot, like going down 2% here. So obviously this moves around a lot, and we want to know, well, what is the mean of the data? And how do we calculate this in Excel? So what we need to do, what we'll first do is just create the space for it. So I'm just gonna, okay, I don't know what happened there. I'm just gonna create mean, okay, and we'll put it here. So now the mean, as we said, is equal to the average of all the data points. And now the Excel function to do this is average. So you do average, okay, and then we just select all the data. Now it's going to go from C2, which is this cell here, C2, until, I need to see how far down this goes. So the returns go up to C1724. So I can simply do the average of C to 1724. Okay, and the average daily return is 0.06%, right? Which is not that large really, but because it's a daily return over time, that obviously goes up. And this is how we calculate the mean. And we'll now go through in detail the other measures as well. Now, before we carry on, just quickly to say this was the mean daily return. Okay, now if we wanted to calculate the mean weekly return, that is the average return per week, we would first need to calculate the returns per week, each week, okay, for which we would need data by week rather than by day. Now in Yahoo Finance, when I download the data, you can actually download it by week or by day. So I've downloaded it by day, but you can download it by week if you want to calculate the weekly returns, by month if you want to do the monthly returns, and so on. Standard deviation. The next concept we will discuss is what is known as the standard deviation. And again, this is a fairly basic, simple statistical concept. I'm sure some of you have seen it. And even if the formula looks a little daunting, do not worry. It's not that daunting, and it's not that important either. So first, what is the standard deviation? The standard deviation tells you how much variation there is in the data. That is, how much does it change from the mean, right? It is also the square root of the variance. So sometimes people say the variance, and variance and standard deviation measure exactly the same thing. Standard deviation is just the square root of the variance. But essentially, the higher it is, it means the more volatile it is. So now if you look at this formula, what we see is that the standard deviation is equal to the square root of, and if it was the variance formula, we would just take out that square root parameter. It's 1 over n minus 1, n is the total number of data points, times sigma, which is the sum of xi, which is each individual data point, minus x bar. X bar is the mean. Okay, so previous we calculated the mean. X bar will be the sample mean. That'll be the mean of all the data points. And we take the difference, essentially what we're doing is we're taking the difference between each data point and the mean and the average, and then we're squaring it. Right? So now the greater is the distance between each data point and the mean. Obviously when we square it, it becomes a positive number and becomes larger. The greater is the distance, the higher will be the standard deviation and the variance. Right? So all this is saying is that the more further we are from the mean, on average each data point, then the standard deviation will be higher. And standard deviation is often referred to as volatility, right? So telling us how does the data vary, right? So for example, we have, let's say, a set of returns, okay, and we have the mean return, but we want to know, is it a fairly stable data set, or does it move around a lot? Do we have days of lots of high return days and lots of low return days? Or do we tend to have a very stable return days? So this standard deviation will tell us this, because it actually looks at the distance between each data point and the mean. Now standard deviation is also commonly referred to as volatility. So next time you see volatility in the finance literature, anytime someone tells you that volatility is going up or down, just know that all this means is standard deviation. All this is measuring how far is each data point from its mean. And once we know this, we can see that it's actually not that complicated. Now, why do we use standard deviation? Well, it's very important for evaluating trading strategies. The fact is that when we want to evaluate a trading strategy, we want to know its return, but we also want to know its risk. And standard deviation is a way of telling us how risky it is. The greater is the standard deviation, i.e. the greater is the volatility, that means it's also more risky. So we want to avoid investments which have very high standard deviations relative to ones with lower standard deviations. Let's now continue our discussion on the standard deviation. So what we have here is a graph showing us the standard deviation of 3 different distributions, all with the same mean. Okay, so we have a Gaussian distribution. Okay, you can ignore the word Gaussian, all it means is a normal distribution with a mean of 10. And the 3 distributions here, the red one has the lowest variance, the green one has the middle variance, and the purple one has the highest variance. So as I mentioned in the previous slide, the variance is simply the square of the standard deviation. So you can just think of this as having the red one having the lowest standard deviation and being the least volatile, this one being in the middle, and this purple one having the highest standard deviation and being the most volatile. So what we can see here is that in the case of the red one, it's highly likely that the values will fall between around 7 and around 13, right? Most of the area of the distribution is between these two values, i.e. it's not that volatile. Now when we get to the green one, we can see that you're probably likely to get a value between around 5 and around 15. Most of the values fall in that range. And finally, in the blue one, most of the values fall between the range of 20 and close to 0, right? You can see that the area expands all the way there, and therefore you're likely to get any value. So we can see here that the volatility makes a big difference, right? The variance of the distribution means that we're likely to see, tells you how far away from the mean the values we're likely to see are. The next thing we will now go through, here we are back on Excel, and what we will do now is actually calculate the standard deviation. So we calculated the mean here of daily returns. Okay, and now I want to calculate the standard deviation. Okay, this is just an abbreviation. And what I need to do is, the function is STDEV. Now, there are 2 different standard deviation functions, population and sample. We want to go with the sample standard deviation because what it means is that we have a sample of data. There's a very small distinction between the two. It's not that important, but it's better to go with the sample standard deviation. It'll probably give you the same value anyway. So you do the standard deviation, and you want to select all the numbers. So we're just going to select the same group of numbers. That'll be C2 until C1724. Okay, and now this here is the standard deviation, right? Which is quite a lot, right? Because if I, for example, want to put this as a percentage, it's close to 2%, right? So we have our mean return is 0.06%, and the standard deviation is 1.80%. Correlation. Correlation measures how much 2 variables move together. It's a number that lies between -1 and +1. So in the case of the standard deviation, what we saw was how much was the variable moving itself. Now we want to look at how much does the variables move together. So I will just briefly go through this formula with you. You do not need to know it. It's calculated on Excel for you, just like the standard deviation. But just for your reference, so in this case we have 2 different variables, x and y. So we take the sum of xi times yi, so we multiply all the xi's times the yi's and sum them up, minus n times the average of the x's, x bar, minus the average of times the average of the y's, y bar, divided by n minus 1 times sx times sy. Sx is the standard deviation of x, and Sy is the standard deviation of y. And this will give us a number between -1 and +1. So what does the correlation value mean? Okay, so if we have -1, that indicates perfect negative correlation. If we have +1, that indicates perfect positive correlation. And if we have 0, that indicates no correlation. So let's think about what is perfect positive correlation or negative correlation. If something that has perfect correlation means it moves exactly in the same way as something else. Right? So if something has perfect positive correlation with something, it moves exactly the same. And that obviously in practice never ever happens. But you can get close. So often we'll express it in percentage terms. So if we have a correlation figure of 0.6, that means it's a 60% correlation. Now the closer we are to +1 or to -1, then the greater is the dependence in the data. Now dependence really means that how much is it actually correlated and affected by one another. So if you have a correlation of say 90% or -90%, that means the data are highly dependent. They move very, very close to one another. And as we get closer to 0 from either side, then the lower is the dependence in the data. So when we have 0, it means there's actually no correlation at all. And if we have numbers close to 0, it means the correlation is very, very weak and probably negligible anyway. So now we'll go back to Excel and try and look at some examples. Now that we've discussed correlation, what it is, let's now go through a brief example. Now we're not going to use the Nifty index because for correlation we actually need two different price series and we want to look at how much they move together. So what I have here is the prices for gold and for silver, and this is just over December 2011. Okay, there are some days where the price gets repeated. That's because the MCX, which is the Commodity Exchange, which is the Indian Commodity Exchange, they sometimes publish multiple prices for the same day, but that's fine as long as they're in sync. So now what we'll do is that we'll aim to calculate the correlation between gold and silver. Now we expect it to be positive. We maybe expect it to be a little high. So what we'll first do is calculate the gold return and the silver return. Okay, because we want to look at the correlation between the daily returns. So the return, if we remember, is going to be today's price minus yesterday's price divided by yesterday's price. Sorry, yeah, that's really 3. Okay, and in percentage terms. And let's add a couple of decimals there. Can do that here. I can also copy that across, and this will give it to me for silver as well. So now I have the returns for gold and the return for silver. And as before, delete the last row. Now I want to find out the correlation. So in Excel, there is a correlation function, and it's CORREL. So we do the correlations. Now you have array 1 and array 2, which means you need your first data set and your second data set. My first data set is the daily gold return. And my second data set will be the daily silver return. .82. So if I do that as a percent, 82%. So that means the correlation between gold and silver is 82%, which is very high. Right? As we said, it'll be between up to 100% is the maximum it goes. So 80% is quite high. And this is what we expect. We know that gold and silver tend to move up and down together when we look at it just casually. And this then confirms it. This shows us that the correlation is indeed fairly high for gold and for silver. The normal distribution. The next concept we will discuss is what is known as the normal distribution. Now we alluded to this earlier when we saw the chart of the standard deviation. So a normal distribution, or what is sometimes referred to as the Gaussian distribution, is the most important probability distribution and looks like a bell shape, right? Much like in the earlier graph. Now it is commonly seen in natural phenomenon, for example heights. So if you look at if you plot people's heights, you'll find that it's normally distributed. It follows that kind of bell shape, that is large concentration in the middle, around the mean, and then smaller observations on the extremes of the mean. Now, what's also seen in finance, so maybe some of you have heard of the Black-Scholes model, which is an option pricing model, and that uses the normally distributed returns. So what is a normal distribution? Well, the important things to know is that normal distributions are symmetric, and they are defined by their mean and variance, or standard deviation. So we can have a normal distribution. Now, if you remember in the earlier slide, we saw it had a mean of 10, and then we had 3 different variances, right? So those were all normal distributions. That was looking at each normal distribution had a mean of 10 and a variance. I think it started with 1 and then 2 and then 5. So whenever we talk about a normal distribution, we think in terms of mean and variance. Okay, so it's fairly straightforward. Now, when is it used in finance? So as I mentioned, the Black-Scholes model is an example of one. And what we do find is that we often, for many financial models, we assume a normal distribution of returns. And this is done because normal distributions are, it sort of approximates what happens in finance. Unfortunately, it's not exactly what happens. We have other financial return distributions that are not always normal. They're slightly different. But nonetheless, the normal distribution can provide us with a variety of valuable insights. So let's now look at what, let's now see what it looks like. Here we have the graph of a normal distribution, and as we can see, the normal distribution follows the bell curve shape as we described earlier. And in this case, we have a normal distribution with a mean of 0 and a standard deviation of 1. This is also known as the standard normal distribution. So what is interesting to know about this normal distribution? Well, we have here the mean of 0, and the first point to note is that the normal distribution is symmetric about the mean. So whatever's on this side is the same as whatever's on the other side. And the other important point to know about normal distributions is that this 68% here, right, this means that 68% of the observations that you will expect to see lie within -1 and +1. And this refers to the number of standard deviations. So 68% of the observations lie within 1 standard deviation of the mean, right? So 34% on this side and 34% on the other side. Now, 2 standard deviations, we have 95% lie between -2 and +2. And what that's saying is that 95% of the observations will be within 2 standard deviations of the mean. And likewise, 98% of the observations will be within 3 standard deviations of the mean. And why this is important is that if we have our mean and we have our variance, or our mean and our standard deviation, then we know exactly what to expect. We know where the values will fall. So if we have a mean of, 10 and a variance of, or standard deviation of 2, then one standard deviation is between 8 and 12. We know that 68% of the observations will be between 8 and 12, right? And maybe stock returns, for example. And this is the beauty of the normal distribution and why it's so useful and why it's so important. Skewness. The next concept I would like to discuss is what is known as skewness. This is related to the normal distribution in that here we will be talking about instances where the normal distribution assumptions are violated. If you remember, when we talked about the normal distribution, we said that the distribution was symmetric on both sides, right? So it looked the same above the mean as below the mean. And a skewed distribution is one where it's not the same on both sides. In fact, it's asymmetric. So skewness actually measures the asymmetry of that distribution. When we have a negatively skewed distribution, what this means is that we are more likely to see values above the mean, and we have a small chance of seeing values far below the mean, i.e. we have a small chance of a large loss. And a positively skewed distribution is the exact opposite. Now, we'll just talk about an example, and hopefully this will make it a lot clearer. Let's think about stock returns. Now, empirically, stock returns most of the time, not all the time, but most of the time, have a negative skew. Okay, so let's go back to our definition. Our definition says that in negative skew, we are likely to see values above the mean, and there's a small chance we'll see values far below the mean. And this makes sense, right? If you look at the way stock markets perform, you'll see that most of the time, on average, they tend to go up, right? But occasionally, once in a while, we have a large loss, i.e. a market crash. So for example, it's quite possible that the stock market can fall by 4 or 5% in a day if it's a very, very bad day. But you'll never see that going the other way. You'll never see it rise 4 or 5% in one day. Right? So you can see in that sense it's a skewed distribution. You're much more likely to fall by 5% than you are to rise by 5%. And that's effectively asymmetry, right? And that means it's negatively skewed. Right? We have a small chance of a large loss. Okay? Now, just to give you an example of what is a positively skewed distribution. Well, if you buy a lottery ticket, that's positively skewed, right? Most of the time we will have a small loss, right? We'll just lose whatever we paid for the ticket, and very occasionally we will have an extremely large gain. So that is also skewed, right? It's not symmetric on both sides. And skewness is important because in finance we're mostly concerned with negative skew. That is, we're concerned with the possibility of a crash. A market crash, and these can happen occasionally, and often these can wipe out all our capital. So we need to be aware of the chances of this occurring so we can risk manage it properly. Before we go on to Excel, let's just take a quick look at skewness here. So here we have two examples of skew. We have a negative skew, and here we have a positive skew. So the one I want to focus on is primarily the negative skew. Now, as we can see, both of these are asymmetric, and they're both opposites of one another. So imagine we're looking at the stock market, okay, stock returns as a negatively skewed distribution. So now this dashed line here, okay, that's the mean, right? So what we can see is that there are a lot of values concentrated just above the mean. But we also have the possibility here, if we're in this part of the distribution here, say from here on back, that part of the distribution, there's a possibility of a large loss, which we don't have here, right? We don't have this fat tail going this direction. So essentially what it's saying is that there's a chance that you'll have a large loss, but there's not really a chance you'll have a large gain in the stock market. And that's kind of what we see empirically, right? When the market crashes, there's a large loss, but it doesn't really go the other way. Okay, so this is what a negative skewed distribution will look like. And positive skewed, of course, is just the opposite. In finance, we don't tend to encounter positive skew very much. But still, it's good to know what it is. Here we are back in Excel, and what we are going to do is calculate the skewness of this distribution. Now, we have calculated the mean and the standard deviation of the returns. So to calculate the skewness of returns, it's fairly straightforward. There's an Excel formula for it. So what we'll do is we'll just do equals skew, and then we just go from C2 to C1724 as before. And then we have the skew. And what we see here is that the skew is positive. It's 0.31, which is slightly unexpected. Normally stock returns have negative skew, but sometimes they can have positive skew. And this is how we calculate it. So this is just useful to know for our purposes. So we know what skew is, and we know how to find it. Kurtosis. Now, kurtosis is another violation of the normal distribution, if you will, just like skewness. And we want to look at kurtosis as a way to tell us whether a distribution has fat tails or thin tails for a given variance. So fat tails means that we are likely to see very extreme values, as well as values very close to the mean. Thin tails, we're likely to see not as many extreme values and not as many values close to the mean. Right? So positive kurtosis, it can also be known as excess kurtosis, and positive kurtosis implies many values close to the mean as well as far away from the mean. And negative kurtosis is the opposite. So most financial assets exhibit positive kurtosis, and this means that there are many days when returns are low, and there are occasional days when returns are very high. Now, it is less important than skewness because it's not really about asymmetry. With kurtosis, we're looking at symmetrical fat tails or thin tails, but it's really telling us is that as compared with, say, a normal distribution, how likely are we to see extreme values? And we are, because we have market crashes, for example, which see large negative values, and then we have also days where there are big gains. And oftentimes these large values don't necessarily coincide with what we would expect from a normal distribution. And this is why we look at kurtosis. Here we have now a graph of what positive and negative kurtosis looks like. So as I mentioned, with positive kurtosis is the blue line, and negative kurtosis is the red dashed line. So with positive kurtosis, what you can see is that we have more extreme values over here, okay, as compared to the negative ones. But we also have values closer to the mean, which is basically what's in here, right? Whereas this negative one has values that are outside. Right, so a positive kurtosis distribution looks like this. It's very thin and skinny in the center, okay, and as well as has fat tails on both sides, i.e. likely to see extreme values. Now with negative kurtosis is the opposite. We're fatter around the mean, near the mean. So near the mean we're more likely to see values away from the mean. But we don't really have the fat tail, so we're kind of over here, we kind of stop, and we don't really have as much of a chance of seeing extreme values. And this is really what kurtosis is, and this is what kurtosis tries to measure. And now what we'll do is we'll go into Excel and calculate it for ourselves. Back to our Excel example, again the Nifty index from 2005 to 2011. And we can now calculate the kurtosis of the returns. And kurtosis is again very easy to calculate, just like skewness. So what we want to do is type in Kurt, which is the short form, and the formula for kurtosis. Again, we'll use the same returns that we've been using all along. And we come up with 8.97. So this means highly positive kurtosis, right? So if it was less than 0, it would be negative kurtosis. If it was greater than 0, it would be positive kurtosis. And this means that there's a high likelihood of seeing extreme values, okay, relative to what our standard deviation is and what our mean is. And we know that this is the case. We can see that there are days when the markets go up by 3-4% in a day, and as a result, that creates the large kurtosis. So this is another way to essentially measure the risk, right? Because we have standard deviation, which tells us the risk, but this tells us, are there extreme days? Are there days where there are many, many fat tails? And that's why kurtosis is important. Now we're coming towards the end of the lecture, and I would like to conclude with a little bit about why we did this in the first place. What is the usefulness of statistical analysis, and its limitations as well. Essentially, the main usefulness of statistical analysis is to provide meaning to the data. Right? So we have data of a price series, and statistical analysis helps us to understand it. And we will use a lot of these tools that we've learned. So for example, looking at mean, standard deviation, correlation, especially these tools, as well as skewness and kurtosis too. We'll be using these tools to analyze stock returns, okay, or returns for other assets. And in particular, what we'll be doing later on is looking at how has a stock done in the past, that is, what is its behavior like, and how a potential trading strategy will perform. So for example, we had those Nifty returns, right? So you can think of those returns as the returns from following a buy and hold strategy, right? So if you buy the index, let's say at the start of the data set, which was 2005, and held it until 2011, that will be your daily returns. And that will be the return from a buy and hold strategy. Now, if we want to analyze return from another strategy, we can apply that to the data, and then we can see what would be the returns from that strategy, right? And then we can look at all the statistical indicators like the mean, the standard deviation, the correlation, the skewness, the kurtosis, etc. And that will give us a way to compare, well, does my strategy outperform a buy and hold strategy, for example, right? And these are the kinds of questions we'll be interested in and what we'll be looking at later on. And what are the limitations of statistical analysis? Well, the main limitation is that we implicitly assume that the past will predict the future, right? The future will be similar to the past, and that's because we're kind of making inferences on what has happened in the past, and we're presumably using that to extrapolate what will happen in the future, right? We're looking at what happened in the past, and we're going to apply it to our future trading strategies. Now, this is the weakness of statistical analysis, but I mean, it's also a weakness of technical analysis generally, that it relies on past data. It's something we talked about a lot in the first lecture. But other than that, there's otherwise there's not much else in terms of weaknesses, so it's not really a big deal as long as we understand this and we understand how to deal with it, which we will understand going forward in the lectures. We can really use statistical analysis to our great advantage, and of course we can use Excel as well to our great advantage.